Get a government view on it, a planning commission view on it. Dr. Saumitra Chaudhuri is noted economist. He's looked at all aspects of the economy as part of his older role and also his new role in the planning commission. He joins us now to give us his reading into inflation and what it means particularly for monetary policy. Dr. Chaudhuri, it's a pleasure to have you here on the show. Let me just first start by asking you, double-digit inflation, just a matter of time. I want to know how we should read into it, how you would read into it, as a transitory phase of excessively high inflation, or something more than that?
Well, if you are already at 9.9, then double digits sort of around the corner, is it not? But having said that, I think one must point out certain notable elements of this release for inflation in the month of February. You may have noticed that the food price inflation edged off. In fact, for several of the subcomponents, the index is actually a level lower than it was in January. So it would seem this reinforces other information that one has, that prices of primary food products, namely wheat, rice, and some extent other products, fruits and vegetables, they may not have fallen, but they stopped increasing, at least at the same pace as they were in the previous month. So that's a very important development, which means that the principal momentum driving element in food prices may have stabilized. So that's number one. Number two, we know the sugar was a very important component of the increase in the overall price level. And sugar prices, as you may be aware, from the last week of February, international prices have crashed. Domestic initiatives regarding releases and better management has also driven down prices, and sugar prices are significantly lower. So these are two important developments and would have to be taken into mind when looking at where inflation might be in March or in the first few months of the next financial year.
Fair enough, Dr. Chaudhuri. So food prices are coming off a little bit, and as a result, primary article prices will come off as well. The question is that would it be offset almost entirely by rising fuel prices and the possibility of rising manufactured good prices?
That's a very good question. Yes, there would be offsetting elements. In petroleum prices, we are, in a sense, behind the adjustment process. So there has to be some corrections which have to be made. That will push down the overall level, but will help us deal with high petroleum product prices and crude prices in the next year. On manufactured goods, you notice that actually only very few items there has been an increase. Inflation is any significant. One of that item is cotton textiles, and that is partly largely due to the rapid increase in cotton prices last year. Other than that, there are very few elements where the inflation is strong. In manufactured goods, inflation is strong in food manufactured products, but not in non-food products, except for these two exceptions. One is cotton textiles, other is non-ferrous metals. Now, non-ferrous metals have gone up because, first of all, they have come down a lot. They were in negative territory and they have recovered a bit. But one must remember one thing, that going forward, there's always some amount of risk that in the international markets, commodity prices may start rising rapidly. In same way, crude oil has recovered from its lows. Other prices may also start recovering on account of a combination of a weaker dollar and or economic conditions recovering in the Western economies. So that's, I think, a big danger going forward, and here you have to be alive to it. But it's not there yet.
Dr. Chaudhuri, just hold your thoughts for a minute. Keep you waiting. Let me just throw one last quick question to you. Apologies for keeping you holding there. What we want to understand from a monetary policy perspective now, and you've said this before, that given the kind of growth we're seeing and the inflation, it's time to neutralize and normalize policy. You still hold that view, and you'd anticipate a move from the RBI sooner rather than later?
Absolutely. I believe first monetary policy must come back to a neutral stance. A neutral stance, by definition, is the stance that you would have had if you don't have rapid growth or deceleration. You don't have a crisis, you don't have recession, you don't have a growth slowdown, and you don't have runaway growth either. You have inflation within target. Suppose you have that, and that's neutral policy. What would the neutral policy be? My argument is that the neutral policy does not correspond to what you have. We have a policy which was created during the crisis. It is very, very easy. it needs to be picked up a bit, because whatever you might say on the neutral policy, whatever specific number you may attach, that this is where you expect the overnight rate to stabilize, it could be 4%, it could be 4.5%, but it's certainly not 3.25%. So there is going to be some, let's say, tightening of liquidity. There should be, to come back to a neutral policy. And from that neutral policy, are you going to tighten on, would then depend on your reading on inflation, how much of the inflation is, however created, should monetary policy address those issues? But I think we need to come back to neutral, and I think that some work is left on that score, even after the action taken with the RBI on 29th of January. So I think some more stuff will get rolled out, because it is not possible to, let us say, go back to neutral policy as fast as we came off and went into crisis mode. It's not possible to match those speeds, so it'll take a little longer, but that's where it first got to get. And then we can take a call as to what's happening on the price front. There isn't that much clarity at this point in time. There are lots of things with the imponderables. There's a possibility that the trade relationships with the United States and China is going to be a point of tension, that the currencies are going to fluctuate even more than they have. So there are these lots of imponderables. We've got to see how these things rolls out and then take a view.
All right, Dr. Chaudhuri, it's always great to get your thoughts on the macroeconomics.